Welcome to an overview of the private equity oil and gas financial model template from efinancialmodels.com. Before we start, if you like to get notified of more videos like this, please hit the subscribe button so that you will receive a notification whenever we submit a new video. Now let's dive into it. What is the purpose of this model? The purpose of this model is that we have various projects in the upstream oil and gas industry. And what we want to do is we want to figure out which projects to pursue and which ones not. And then we want to consolidate them into a portfolio. And then we want to run a simulation. How would an investment structure look like and what kind of returns potential investors could expect when running through these figures. The model is structured that we have a variety of worksheets. We have summary sheets, which summarizes the consolidated business case. And as you can see, we have various drilling projects. We can either include them into the consolidation or not. We also will see what their metrics will look like, and so we have a bit the summary of the overall perspective, but we also will have a summary of each and every individual project so that we can basically understand which projects should work out financially and which ones not. So let's get started and let me explain you how to calibrate this model. To calibrate the model, we need to work through the assumptions. We have here three types of assumptions. One are general assumptions which apply throughout the model. Then we have project-specific assumptions where we have to calibrate each of our drilling projects. And then we have the uses and sources of funds assumptions, which are also, again, project-specific in their structure. So we will start here. It's already started, but basically what we need to calibrate is the outlook in terms of the prices for oil, gas, or natural gas liquefied. What are the price assumptions which should apply throughout the model? In case these prices change, what's the yearly change in price? Then we also need to, we can define our cost structure. These are always, every project will have the same cost structure. So we can set here, like here we have certain labels, we can label these costs. We also have, if applicable, certain types of taxes. So we can also work through that. So either taxes are dependent on revenues, on volumes, or as income tax. In this model it's assumed like this, and so on. So we will set here the general assumptions. Then we will proceed and we work through each of our drilling projects. We have here one name we can give them. We can have here one toggle. Later we'll come back to that if you want to include or exclude. What will be the start year? As you can see, not all projects are supposed to start the drilling in the same year, so we can phase this out and smoothen a bit our cash flow pattern if we like to, or we can start all the projects at once. So these are a bit the assumptions, and then we go also to the production assumptions. Here we have oil, gas, and natural gas liquefied. Here we need to define what's the peak production, and then also the annual depletion rate. And the way it works is, if we go here to one of the project sheets, is that we are going to use several years to do the exploration, the drilling. Then we ramp up, as you can see, we ramp up the production, and here we peak. And then every year there is a depletion factor, so this is slowly going to deplete. And if we now look at the project summary, and now this is the pattern. Now, of course, here the cash flow stopped. The reason is we have only assumed a lifetime of 5 years. This is not very realistic. So what we're going to do is we're going to use the due diligence results to estimate what is a likely lifespan of this project. We can enter the years, we go back to the project summary, and now you can see the cash flows are, or basically revenues and EBITDA are projected like like this. They go now up to year 12, and then also the free cash flows. We can see that they break even here after 4.5 years. And we'll have to work through all the assumptions. So these are assumptions related to volumes. In terms of the prices, we have the general assumptions we take from the general assumption sheets. Then we need to work through the ramp-up schedule. As said, these projects are going to be ramped up, so we can assume the phasing a bit different depending on the project. Then we also need to define how the capex is going to be spent. In this case, it's very easy. We just assume one set of general assumptions. So we are first year, we're going to buy the land. Then we spend something on exploration. Make it a bit bigger here. We buy some equipment, and we have to incur the costs for the drilling. That would be the capex phasing plan we can assume, and we can either assume everywhere the same, or we can change that in the model by overwriting the assumptions here. Ongoing capex is the yearly maintenance capex to be expensed. And then we also have to work through the cost assumptions. As said, these labels we're going to set here on the labels section. They're flowing through here. And then we can enter some costs as a percentage of revenue, depending what type of costs we have. Some costs will depend on the volume. And as you can see, each well, sometimes it's an oil well, sometimes it's a gas well. We assume the costs as of the main resource, so we can set the cost structure here. If we also have some fixed costs, we can also assume them here. Then we also have debt and profit sharing assumptions. They can also be modified. I will get back to this in just a bit. Lastly, we also need to define the initial investment. So we need to define what positions we're going to spend. We can here assume a standardized set of expenses applicable for all projects, and then we need to work through and assign the budgets so that we know how much each of these drilling projects will cost us to undertake. Once we know that, we also can estimate how much debt financing we can get. As you can see, this debt financing depends on the amount of capex. Here it's assumed. That's just one way to model it. And as you can see in the initial cost budget, these are the capex items, while these are the opex items. Opex going through the P&L, they're being expensed, and the capex is going through the cash flow statement. And once we have this assumption, then we can also determine how much debt financing we get, and the rest will have to be financed through equity, and then that will be the amount we have to organize the financing. So now if you want, for instance, these figures a bit to be rounded, we can here do one goal seek. Let's say we want this one to be exact $16.5 million. So what we can do is we just set this here to the target. And we have here a cash buffer, so we can play around with that, because normally it's a bit easier to work with rounded figures. And the same could be done here. And as you can see now, we have a rounded figure for which we can use when we do the calculation for funding, for equity funding. Now all assumptions are set. So what we're now going to do is to review the individual drilling projects. So we have here these sheets, and we start with the first sheet. First is we review what kind of assumptions we have been pulling together from the assumptions sheet. And as you can see, there is a whole section which basically summarizes when the project will start, what's the main resource, what's the peak annual production, etc., etc., what's the total uses and sources of fund, and then also the investor structure. One thing I forgot is, in terms of the investor structure, we have here the uses and sources of funds. table, and what we can do is either have the investor participate at the project levels or at the consolidated level. In this case it was set as consolidated, but what we can do is we can change that. And now what we do here is, so let's assume that every project is funded. In that case, let's go back, use and source of funds. In that case, these assumptions play a role, and now we can vary. We can basically say one investor has only X% stake in this project and a different percent stake in another project, so the percentages here can vary quite a bit. And then this allows us to run a simulation if these investors participate in only select projects. And in that case, the consolidation becomes more a pro forma consolidation, since investors' cash flow are distributed at the project level and not at the consolidated level. This model gives you both options. You can run both simulations, either let them participate consolidated or at the project level. So if you're going to do this at the project level, then you will see in the project sheet that now we have here the investor structure also properly reflected. And then we also have a profit sharing scheme for which we can pull the assumptions together. So what we're going to do then is to review if all these assumptions make sense, just a quick glimpse through. And once this is fine, we'll have to shortly go through the calculations and see if this makes sense. Let me make this a bit smaller so we can get the big picture. So yeah, here this is the P&L. As you can see, these are the first years where the drilling is going on, and then the cash flow and production is being ramped up. And then here it achieves peak production, and then it's going to slowly decline, which is reflected in the revenues. And you can then review basically if all these costs make sense to you. If they don't make sense to you, simply go back and recalibrate the model by changing the assumptions, costs, or also volume assumptions. Just change them here on the project assumptions sheet. So this is what we're going to do. We have to review if this all makes sense. As you can see, we have here P&L, balance sheet, cash flow statement, and all the other, quite a number of calculations. Most important is the free cash flow forecast, so that we can understand what's the project-specific free cash flow this project will generate. And here we have it unlevered, we have it levered, so that we can then calculate all the feasibility metrics, which are summarized here at the bottom. And then we can see if this makes sense. If this is too complicated, we have here a condensed view. So for each project, we can pull the figures together. And if we go back to project one, so you can see now it's a bit easier to read. So we can see here the charts, how the profits, revenues are going to develop, the free cash flows, how the project is going to be funded. We see here all the expenses once more summarized, and we can see if that makes sense to us. And then also one word regarding these investors. If you remember, we still have these investors participating at the project level in this scenario. So what we're going to do is we have to start with the cash flows available to the investors. And these are basically calculated here. What we do with them, we run them through a profit waterfall distribution model. Let me see if I can find it. So we define when does investment have to be happen, which years, and in which years the proceeds will occur. And once we have that, we apply the limited general partner funding structure. We have two hurdle rates. If you remember, let's go back here. These are basically the ones we used. In this case, we have a hurdle rate of 8%, 15%. If the hurdle rate 1 is achieved, then we get 15% goes to the general partner, and if it's 15% IRR, then basically goes to 20% goes to the general partner. This is a standard profit sharing scheme, and we are just want to simulate how this would look like. So we do this, and then based on that we calculate also the investor specific returns by taking account this profit sharing scheme. Then I think that's it, what I wanted to show you in terms of the project. So we now have to work through project by project until we are clear for all these, how this is going to work out at the project level. We do then a comparison. That means we can compare if these projects, if we rank them in terms of IRR, if it terms on the yields, if they make sense. As you can see, we have here some outlier. This one is not doing too good. This also is a bit low. But sometimes it could be that for whatever reason this ends up like this. Now maybe the question will then be if this is going to be actually execute this project or not. And this brings us to the consolidated financial plan. So what we are going to do, we have here one sheet where we pull together all these projects. These are a lot of tables, so we have all the calculations here, but let's work with the summary sheet here. In this case, what we can see here is overall, if we do all these projects in this order, then we can see basically how much value we can generate, and we can also see which projects will contribute how much to the net present value of the overall value of the consolidated, in this case consolidated in investment or consolidated business. What we then also can see is the cash flow pattern. As you can see, there are a lot of investments here, and then also here it still goes down, because if you remember, not all projects are being done in the first year. So we're going here to heavily spend, we invest. That's why the cash flow is so negative, and then it turns, and then these oil and gas wells come into production and they start to produce the resource and generate money. And as the production declines, then here it will phase out. And then we can analyze a bit which how these profit patterns look like, what's the revenue breakdown by resource, and also by project. And as said, some of these projects might not work out. There are some candidates in there which we might not be financially feasible. So in that case, what we're going to do is, let's go here, project assumptions, and we simply will exclude them. So I hope I got the right one. This is number 3 and number 4. So let's go back. Sorry, summary sheet. And as you can see, now these are excluded, so they don't contribute to the NPV. And we focus basically on these projects which have higher IRR. And then we can understand a bit how the overall IRR will look like, either unlevered or if we can get debt financing levered. What will be the revenue breakdowns, etc., etc. All the charts will be updated, and we can run a scenario how that would look, how it would look like. Then, in case we would not like this cash flow pattern, what we could do is also to move around the timing. So let's say here we could maybe wait a couple of years until we do the next projects, the next drilling project. So we phase this a bit out. Then here always 2 projects per year and 2 projects per year. Okay, so if we phase this out, then you see the cash flow pattern will change. In this case, maybe not a good idea, because there are a lot of years negative, so maybe it was a bit too much. We might have to go back again. Another scenario would be, let's say we invest a lot in half of them in the first year, So we just get going, and then let's say we have a phase 2, where we do the second batch of projects in, let's say, in year 5, and we can play around and see how this cash flow pattern would look like, and also a bit see how this would impact when do we expect how much revenue from which resource. So this model should give you a tool to run these simulations. Then another question which might come up is, we go back again to the investor participation. So we have here one sheet. Let me show you that. And in that sheet, we can basically sum up project by project which investor is participating in which project. We can aggregate all these cash flows, and then based on their participation, we can basically calculate how their returns, here IRR, would look like. And then we can run another scenario. We can basically, in this case, we could say, okay, now let's, instead of doing project by project, we let them participate at the consolidated level. So all this is being ignored in this model, and we apply a new funding structure here. Here is the same thing. Consolidated cash flows, they're subject again to a 2-tier waterfall model. So in this case, we take the consolidated free cash flows to equity shareholders. We split again in terms of investment to proceeds, general limited partner, and we run them through a 2-tier waterfall model, hurdle 1, hurdle 2. And then we can calculate these cash flows. And then what you see here, if you go to the investor sheets, is that each investor is not participating at the project level anymore. They are participating at the consolidated level. And this gives us then here, can lead to different IRRs or different results. And we can run the analysis here to see how that would work out. This is then also summarized here at the bottom of the summary sheet, and we can basically understand a bit better how these IRRs would look like, and also in terms of the risk and rewards, who invests how much and who gets which reward for all the work done. So yes, so that's more or less what I want to show you. There are 2 more things I would like to show you. One is a monthly budget. So for the first 2 years, another question which could come up is, in this case, we can say we have here year 1 or year 2. So if you want to plan, we have the yearly plan, and then we want to know how would this look like on a monthly basis. What we can do is we can allocate this yearly cash flows allocate by allocating the percentages to each month, and then we can, in this way, we can come up with a monthly budget in terms of the P&L, but even in terms of the cash flow. So we can just roughly say when the investment will happen, when the financing will happen, and then we can actually even simulate how the cash balance during the first year on a monthly basis might look like. So we can do this for the first 2 years, or you can just basically select here any year you want, and then allocate these cash flows and basically prepare a monthly budget. Another thing I wanted to show you are sensitivity analysis. We have here calculate a lot of IRRs. So we have here project IRRs. Maybe better I show this here. So the project level, we calculate unlevered IRRs, the levered IRRs. We calculate the consolidated IRRs, and we also calculate the investor IRRs. So any of these I can select. In this case, I've selected the consolidated unlevered IRR, but I could also just look at project 1. And then these tables, they're not updating automatically, just to save a bit CPU. But if we update those, you see now the model takes a bit a while to update. I cannot click. but then it gets updated. So we have here the unlevered IRR for Jamaica, and we can then run a tornado diagram and see exactly how any change in price, for instance a 5% change in price up or down, in this case actually 10% up or down, will look like. We're going here, as you can see, we go 2 steps up and 2 steps down, and this is the impact on the IRR, and then it's plotted here on the tornado diagram. And we can basically check the sensitivities for any of the IRRs here calculated if we are interested to understand a bit more how the model might react. So I hope this, now let's turn this off again so that the model does not block us. So I hope this gave you a good overview what this model template can do. It's a complex model, but it's also quite useful if you really have to deal with a project portfolio and you need to run simulation which projects to exclude, to include, to exclude, and obtain a bit a more solid understanding of your business plan. So hope this walkthrough was useful. If yes, please give it a thumbs up. Please subscribe to our channel so you get notified of any future video, and visit our website efinancialmodels.com. A link to the model is included in the description below. Thank you for watching.